Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So let's take an example again. As I was doing this presentation, the value of the CDD was fluctuating. So here we have the CDD trading at 101.65, and we might be of the belief that the option premiums are pricey. We want to be a buyer. We want to take advantage of a directional move, but we think that the option contracts are too pricey. Well, the March 101.5 call options at the time this morning were trading at about $3.40. So the market maker was asking $3.40. Just to give you an idea, I was looking at the straight call option example last night, and the ask price was $3. So you can see that when the currency moves during the overnight session, that move is actually already incorporated into the option premium as the market opens. So now we're looking at a 101.5 call option asking $3.40. Well, the March 104.5 call options is bidding $1.98. So remember that as an option buyer, you're going to pay the ask price. If you want to get in right away, you're going to be paying what they're asking you to pay, which in this case was $3.40. As the seller or the option writer, you're going to receive the bid price. You're going to get what they're prepared to pay you. So in this case, we're looking at collecting $1.98 per contract. So the objective here is that we're going to buy one 101.50 call, and we're going to pay out $3.40 or $340 for the option contract. We're going to sell the 104.5 call options at $1.98, and we're going to collect $198. What this results in is a net debit of $1.42 or $142. So you can see here what we've done is we've lowered our cost basis from $3.40, which would be the outright cost for the purchase of the call option, all the way down to $142 or $1.42. Now, some people are suggesting that they're having some trouble with the sound. So hopefully not everybody is having that issue. Somebody was saying that there's a reverberation or an echoing, and I'm not sure whether or not it's because somebody has opened and joined the meeting twice, and that would be my only solution. But nonetheless, as long as everybody's still doing okay, I'm going to keep moving forward. And I guess Steve.
Hey, Chase.
Yeah.
The sound is fine.
Okay,
and
good.
You actually hit the nail on the head.
Okay.
One or two of the attendees are logged in twice, and then they'll get a sort of an echo.
Okay.
So I always urge people, please do not log in twice.
Okay.
Thank you, Chase.
Okay, perfect. Good stuff, guys. Thanks for your patience. Now, as I mentioned, what we've done here, and I want you, while I'm explaining this, to keep in mind the straight call play that we were looking at previously. Remember that the initial cost of the call option was going to be $3. Well, in this case, if we were doing the trade today, $3.40. Remember the influence that in fact, had on our break-even point. As we create this debit spread, notice that the cost to us is in fact reduced down to $1.42 or $142. Now, the maximum risk for this trade is our net debit. So in other words, we've lowered our maximum risk on this transaction to, in fact, less than half by being open to the idea of creating a debit spread. But at the same time, we've actually limited our profit potential because we cannot profit any more than our spread differential minus the debit. But again, if we're considering the risk of overpaying for our option contracts, then this would be a limitation that we would be more than happy to take on, so that we increase the probabilities of us being right and in fact profiting. So maximum profit equals the spread differential between the purchased call and the sold call minus the debit. So first of all, we need to determine what the spread differential is. Well, in this case, it's a 104.5 was our short call. Subtract 101.5, which is our long call, long call, and we get, in fact, a spread differential of 3 points. We take 3 points minus our cost, which is $1.42, and we get a maximum profit potential of $1.58. Now, the important consideration here is our break-even point, because our break-even point now is the long call strike plus the debit. So no different than what we were actually doing to determine the break-even point of our previous option play, of our straight call option play. But now our break-even point is in fact 102.92, so it's significantly lower than what it was if we were the outright call buyer. So in this case, you can see here what we have, once again, is the chart of the CDD, and this is a chart from this morning, and you can see that in order to initiate this trade, we're going to buy one March 101.5 call. We're going to pay out $3.40. We're going to sell one March 104 strike, 104.5 call. We're going to collect $1.98. Now, most standard, I shouldn't say standard, but most brokers that have an active trading platform, or a platform that that caters to active option traders, will have a template that will allow you to create this strategy all in one transaction. In this case, to visualize this from a chart perspective, our outlook is that we may see support here down at the just at the par level. We may see this break above this 101 level, and we may be looking to trade a move higher. We're going to sell, or we're going to buy the 101.5 calls, and we're going to sell the 104 strike call options higher. Well, our objective, or our outlook, might be that we may not see a move any higher than this level. So our expectation may be, in fact, that over the next couple of months, that the CDD only trades as high as 104.5. In which case, so what if we've limited profit potential beyond that? Because all we're looking to do is capture this move in between here. Now, with that being said, you can see that the cost of this particular transaction, based on the buy and sell, is lowered all the way down to 142. Now, in this case, our break-even point, and you'll have to, I'll just clear all the annotations here. The break-even point here is 102.92. Our straight call option play break-even was all the way up here. Our break-even point with respect to our debit spread is all the way down here, down at this 102.92 level. So you can see that realistically, for us to make the full profit on this particular trade, the option, the CDD needs to be essentially trading at or above the 104.5, but we profit anywhere above essentially 103. Now, the important consideration here is, what we have to remember is that while we're making money on our long call, if the move happens very quickly, we're going to be losing money on the short call, and that's because of the influence that implied volatility is having. On the long call holder, an increase in implied volatility is great, but if I'm a short call writer, that actually has an adverse effect on my position. So where I'm profiting on my long call, I'm actually seeing that profit being mitigated by my short call. What needs to happen is one of the other external factors needs to start influencing the position. That external factor is time. So as we move forward in time, our long call position begins to generate intrinsic value, offsetting the impact of time. Our short call position is still out of the money and is being influenced increasingly by time, in which case our profits begin to be recognized, not realized, but recognized, or the position becomes more profitable the closer we get to expiration, reaching full profits on expiration when the stock is trading at or above our 104.5 strike call option.
Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.